Hello, friends. Welcome to Logistics of Logistics podcast. My name is Joe Lynch. Thank you so much for joining us today. Today's topic is the supply chain roadmap with my friend Mike Droesch. How's it going, Mike?
Hey, Joe. It's going well, thanks. Good to be here.
Good to have you here. Mike, please introduce yourself and your company and where you're calling from today.
Sure. I'm Mike Droesch. I'm a partner with Bessemer Venture Partners based in our Boston office, and I'm calling from my home just outside of Boston.
So what you said, Bessemer Venture Partners? What do you guys do?
Yeah, Bessemer Venture Partners is actually one of the oldest venture capital firms in the industry. And so we invest across every stage, but we're largely focused on investing at the earliest stages in technology companies. We work closely with the founders, help them build their businesses over time. And then because we have a large fund, we're currently investing out of a $3.8 billion fund. We have the ability to invest much more capital as the companies grow and need more capital.
So isn't that like a steel furnace?
Yeah, that's very good knowledge. A lot of people don't get that. But yeah, I can give you just a quick history on where the name comes from. So the roots of BVP actually go back to the Carnegie Steel Empire. And Henry Phipps was Andrew Carnegie's partner in the business. When they sold the business, he created essentially a trust for his descendants. And over 100 plus years, that got invested in all sorts of really interesting long-term oriented projects, which over time became more and more technology oriented. And the trust had a mandate to invest in long-term oriented businesses. And so around the 1980s, that trust spun out into different entities, one of which was Bessemer Venture Partners. The name comes from the Bessemer steel process, which is the process that enabled them to create steel faster and cheaper than many of the competition.
Oh, yeah. They did pretty well. They did pretty well for themselves. So, Mike, you mentioned you guys do investments in supply chain. And I know before we hit record, you talked about some of your investments in this space. And we'll go into more detail about those in a minute. But tell us a little bit about some of your investments you've made in the logistics and supply chain space.
Yeah, no, I'd be happy to. And I would say the firm broadly invests in every category of technology. And I personally took an interest over the last 3 to 4 years in supply chain and logistics. And so we've made a number of early stage investments, including Optimal Dynamics, which is a optimization software for large trucking carriers, a company called Raft AI in London, which is workflow automation and AI for the freight forwarding industry. Good Ship, which we recently announced, which is a procurement platform for shippers and carriers to better run their contracted freight procurement processes. Cargo One, which is a freight bookings platform for air freight based in Berlin. And then Curd, which is a last mile fulfillment network for construction and industrial distributors.
I think a lot of people in my audience will recognize those names because I've had a few of them on my company on the podcast. Raft, Good Ship, and I've definitely heard of Optimal Dynamics and Cargo One. I think what's interesting now is we saw so much VC activity prior to COVID, and it felt like a different time. It was a different time. During COVID, it just seemed hot as could be, hot as the Bessemer oven at that time. Just go. But then all of a sudden it seemed like, the wind came out of that balloon. Some of the big high flyers floated back to earth and some were doing very well. But all of a sudden it feels like, is there still venture capital in this world? And I know there is. So from your perspective, what's changed in the market over the last, let's just say post-COVID?
Yeah, it's a really good question. I do think there were a number of factors that drove this. First off, just the venture capital industry in general kind of hit a peak during that time frame and has come back down to kind of more historic norms. But in supply chain in particular, I think we suddenly had so many companies that, at least on the e-commerce side, exploded in volume, which created a lot of opportunity for things like warehousing fulfillment to support the e-commerce boom. And a lot of businesses that I think are going to end up being good, sustainable, long-term businesses, but any business that whose revenue is directly tied to freight rates saw an extra acceleration during that time, because not only was the volume growing, but the rates also increased substantially. And so they grew at a really incredible rate for that period of time and attracted a lot of capital. And unfortunately, as we all know, supply chain is inherently volatile and it's cyclical. And so when rates inevitably came back down, I think investors who maybe didn't have as much of appreciation for the cyclicality of the industry pulled back in terms of their interest in those businesses. But I still think there is a healthy base of investors who have spent a lot of time understanding supply chain logistics who are still really excited about investing in the category.
Yeah, we have some of these high flyers, and let's talk about Convoy for a minute. They were on the podcast a few times. I really like those guys. And I think they had Jeff Bezos in there. Bill Gates was there. The guy from eBay, I can't pronounce his last name, Pierre Omidyar, whatever it is. He should change it. But we had the wealthiest people in the world investing in Convoy. And I think they zigged when they could have zagged. It was a great company. I think they raised the whole bar for this industry. But I think other people, and LinkedIn, a lot of people will say it was fundamentally a freight brokerage, but getting money like it was a technology company. And we've seen others like that. And we have warehousing and fulfillment feels, we see consolidation by tech companies. They aren't buying the warehousing, but they're connecting them. And some people would say, oh, how do you invest VC money into warehousing? That is a business they wouldn't be into, but they would be into the technology that connects a whole bunch of warehouses nationwide or worldwide. So it's funny, there's a lot of parts of our business that have no business with venture capital. It just doesn't work for you guys because you want that hockey stick growth because of the nature of your types of investment. So please elaborate.
Yeah, this is a really good insight. And I'll be the first to admit, I don't have a deep supply chain logistics background before I came into spending a lot of time in this category the last few years. So the first thing, at least that I did when I came in, was say I wouldn't feel like I have any advantage investing in a company that requires deep operational expertise. And so that's where I just, given that filter, decided to steer clear of some of the things that were either tech-enabled services, like a brokerage, like a warehousing fulfillment company. And so I was specifically looking for things that are software that we can sell to the existing industry incumbents. Because to your point, venture capital is generally focused on software businesses because they can grow really quickly with limited amount of capital. Now, obviously, other business models also grew really quickly during that time frame. So they were able to attract capital that they probably wouldn't have otherwise, just because of the sheer growth rates they saw during that time.
Yeah, I was at Manifest, not last year, the year before, and I went to venture capital company I won't mention now. I went and I had interviewed a lot. They had a cocktail party the night before, and I saw some friends, and I was talking to one of them, and he says, well, there's still a hardware element to our service. And he said, we're trying to shed it. I was like, yeah, I said, because you're VC backed. And I said, there's nothing VCs hate more than the physical world. He goes, and he laughed and he said, not really. He goes, but it's just, they want the advantage of the business that is technology, that is software, that can have that hockey stick growth. If there's hardware, that kind of implies somebody's installing it, somebody's manufacturing it. It's a little different vibe than the software.
It's totally a different vibe. And not to knock all hardware businesses, we've got some great ones. We have companies sending rockets into outer space and doing like really impressive work. But I do think building a startup on its own is really hard. And then hardware in addition, the saying hardware is hard is true. It just adds another level.
Right. Yeah. Yeah. It's a friend of mine I grew up in Michigan and I'm still here. And one of my friends, he went to MIT and then he ended up in Silicon Valley. And then he moved back to Michigan not so long ago. And he said to me, he says, they call it Silicon Valley, but there's no hardware there anymore. The hardware moved. I was like, oh yeah, Silicon is not software.
That's very true.
Mike, tell us a little bit about you. Where'd you grow up? Where'd you go to school? Some career highlights before you joined the juggernaut that is BVP.
Sure. I grew up in suburban Long Island. I went on to go to Tufts University for undergrad. I studied mechanical engineering there. Had always been interested in building big things. Yeah. And then I actually ended up going a little further on the engineering path. I got a master's degree in naval architecture of all things from University of Michigan.
Oh, go blue. That's right. That's where I went. I got my master's there too.
Oh, amazing. And then, yeah, my first career actually was working as an engineer at a small naval architecture firm. So we were doing ship design and retrofit engineering projects. Super interesting hands-on work. From there, I moved to a consulting firm.
So you've lived in the supply chain. That is the supply chain.
It briefly touched the supply chain, I would say. Yeah. But that's the closest my experience got to being hands-on. And then from there, I moved to a consulting firm that was hiring engineers at the time to evaluate emerging energy technologies. This was around the time there was a clean tech boom around 2010, 2012, where venture capitalists were funding really innovative clean tech companies at that time. And I happened to join this consulting firm that was helping the Department of Energy and other large companies evaluate what technologies should we invest in. And so I got exposed to a bunch of some really interesting, some totally wild and out there clean tech technologies. And that is the first exposure I had to venture capitalists. I was thinking, who's funding all of these really innovative and risky concepts? And so it opened my eyes to this world that is venture capital that I honestly didn't really know existed. And so through spending a little bit more time in that world, got to work with a clean tech venture capitalist for a little while, ended up deciding I really wanted to make a career out of venture capital because it is such a fascinating role. We get to spend all of our time with entrepreneurs who are super smart, super passionate about what they're doing, building really interesting businesses. And so went back to business school, worked with a couple Bessemer-backed companies while I was there, and was really fortunate to join Bessemer when I graduated.
Very nice, very nice. And I know one of the challenges of being a VC, a friend of mine who has done that job said, because they typically like to hire really smart people. He goes, but the challenge you have in that is you're always thrown into an industry and you have to figure out where to make these investments. And he said, and these are brand new kind of game-changing investments. And so when somebody says, hey, we're going to change the game, you go, I need to understand what the game is right now. And he says, that's why so often they want a big stake. He goes, because it's the home run or nothing, right? There's nobody wants a single in the game you're in.
That is true. We end up with a whole distribution of outcomes from we lose some capital on some, we get a lot of singles and doubles, but it is the home runs that drive the returns for the entire fund. Is the way the model works. And you're right, we do spend time. Part of our approach is we try to be really thesis driven. And when we're looking at a new industry like supply chain and logistics, we try to spend the first 6-12 months just talking to experts, talking to everyone we can to understand how does the industry work, where are the inefficiencies, where are the pain points that the operators have today, to ultimately build a foundation for an industry where we might not have as deep of natural expertise.
So today's topic is the supply chain roadmap. And I know that is not only a thesis, but I think you have a video that you're in on your website. I did not watch the whole thing, but I watched some of it. It's very interesting. How long is that video?
I think it's 6 minutes, something like that.
So I'll make sure we'll put a link to that in the show notes so people can see that video. And so what is the supply chain roadmap that you and the BVP people have created?
Sure. So roadmap, very simply for us, is just our internal word for a thesis. And so at any given time, we'll have our structure is very decentralized. We'll have 20 or 30 different roadmaps going on with different teams pursuing them. For me, I got interested in supply chain and logistics around late 2020, early 2021. And in hindsight, it was somewhat obvious reasons. We were all living through the supply chain disruptions that were top of mind for everyone. And I recognized that we didn't have, as a firm, we have teams focused on every major category of the economy. But supply chain logistics is over 10% of global GDP. We had nobody thinking about how can technology have an impact here. And I started with a handful of colleagues to do a bunch of research, try to talk to folks who are really smart, have spent their careers in this industry, to identify where are the opportunities where technology could have an impact. And so we slowly built out a thesis with first some simple macro drivers, reasons why we thought now it would be a good time to be investing in supply chain and logistics software. The first being, obviously, we had seen massive shocks to the supply chain ecosystem at that time in particular. This was 3 years ago, but I think it's still being true in many ways. We continue to see big shocks to the system. And that had created real demand, particularly from large enterprises, to invest more in technology to provide more resilience and bring more efficiency to supply chains. And then the second was we felt like there had been this steady progress being made of digitization, digitizing the physical movement of goods. We've just got so many more data sources now than we would have 20 years ago in terms of asset trackers, IoT devices, cameras that can identify the movement of goods, satellite imagery. It's really incredible how much data there is now. And so we felt like we were at this moment in time where we have a lot of data. We have real demand from enterprises to invest more in software to help manage their supply chains. But a lot of the data was still stuck in these silos. It was stuck in an on-premise system record at a big company. And thus it was really difficult for supply chain operators to put all that data together and make sense of it. And so we were identifying that we thought there was an opportunity to build application software, the applications that we're all used to using, that pulled all this disparate data together to help with different use cases. And we started to outline some of those use cases and have started investing along those theses.
And I've said this before on the podcast, but I think it's worth noting is that when we first started doing more stuff with software and online, it was easy to develop a software like a productivity software that was local, an Excel, all those kind of things. And that was easy because it wasn't connected to the other side of the world. But now when you think about like supply chain, we didn't even attempt to connect the dots until later in the game. Factories all they're self-contained, but the stuff that was coming to that factory from Mexico, from China, from all these countries around the world was anything but connected. And when I worked in automotive, I would get weekly updates on my stuff coming from China, weekly. Now it seems ridiculous. And when I would ask my supply guy, hey, where's that stuff? He would always say, your stuff's on the slow boat from China that they always talk about. And I was like, that used to be a saying. I don't know where it came from, but weekly updates. And now we get that just won't do anymore. And I would also say the discipline of supply chain has grown. So you said, I don't have any supply chain background. I used to say the same thing. I worked in engineering. I went to suppliers. I worked with purchasing day to day. We developed suppliers. We moved freight. We worked with purchasing, negotiating. That's all supply chain now. And we didn't look at it that way. It was purchasing was there, transportation was there, supplier development was there, but we didn't call it supply chain. Now it's being looked at as a discipline. And I would also argue that going back in history, Henry Ford, when he had, I think in the 20s, had a completely vertical supply chain. It was just him. There was completely integrated. He was cutting down the trees, milling it. He was growing rubber in Brazil, I think. Now it's like the last thing an automotive company would do. They're trying to say, what else can we get rid of? So the world has completely changed in a century, of course. But so supply chains are now expected that they're going to be optimized locally. But how do we connect all those? And to your point, we have a lot of silos that, and then you throw in the trucking companies and the warehousing facilities. It's a lot to connect.
I totally agree. And I think to some extent, while I would love, particularly as a naive outsider coming into the industry, the first thought would be, why don't we all just agree on a common standard and we'll all pass data, right? That's the first naive question you ask. And then you realize the way things really work. And I do think paper in many cases will continue to be the standard because it is the lowest common denominator of information that's accepted anywhere in the world. Scanned paper, documents, PDFs, email is going to continue to remain a really large portion of the way that we transmit information, particularly internationally. And that's part of the reason that we've looked for companies that can make sense of that messy data without having to force your counterpart to adhere to your standard.
So before we hit record, we were talking about four other points you wanted to talk about. So the first one was workflow optimization. How does that workflow optimization work in this supply chain roadmap that you guys have developed? What does that even mean?
Yeah, so I think we had there was on the optimization side, we looked for a lot of areas within supply chain where decisions are made based largely on human intuition and experience. And I think there's we were always going to need that human judgment in supply chain, but we found that there were certain categories of the industry where you're operating on razor thin margins. Let's take trucking carriers, for example. And a lot of the decisions about which loads should we accept, which trucks should we assign to what loads, are made based on humans who have been practicing that profession for a really long time, have really good judgment. But when we heard that, we thought, if we're placing a ton of emphasis on human pattern recognition, for instance, that seems like a really good application for machine learning and for software to help bring better optimized truck and carrier networks. And so that led to our investment in this company, Optimal Dynamics, which is a business that was actually spun out of the University of Princeton, and some research that had been done there by a guy named Warren Powell, who wrote the textbook on logistics optimization and operations research. His son and a bunch of their PhD students spun the company out to bring this research they built to large enterprise trucking carriers. And so we invested in the Series A in late 2020, I believe. And the company provides software to large carriers, some of the largest carriers in the country. And it helps provide the dispatchers, the planners, with a quantified recommendations for which loads, which lanes are going to provide you the highest either revenue per mile or on-time service, whatever metrics you're trying to optimize for. And so that's a way that we saw optimization software helping to augment the humans, obviously still involved to exercise.
Yeah, and there is still lots of paper involved. There's the signing of paperwork happening there. And it is interesting also when you look at trucking, the top players have what, 1.5% of the market? The top players that everyone knows their name. And I don't think that's going to continue, because I think the very biggest companies are buying trucks at a better rate. They're getting better interest rates, but also they are going to change their unit economics through investments in stuff like optimal dynamics. And John Larkin was on the podcast. He's a private equity guy, kind of emeritus everything, venture capital. And he talked about, he saw the largest trucking companies getting larger. And by the way, we still have this really long tail on that distribution. So we're always going to have the small carriers, and we're always going to need them. They add so much value. And I think the majority of the capacity is in that long tail. So the guys who have 10 trucks or less, or 5 trucks or less, I forgot the stats, but it's a crazy amount of the trucks are owned by small companies. We're always going to have those. But somebody's got to help us organize better, because we don't have as many people as we used to. I'm a baby boomer. As the baby boomers retire, we're going to have to be more efficient, because there are fewer people. And you're also going to have to figure out a way to make trucking more attractive. I don't know how we do that, but we have to do that. And I think technology is part of the way we'll do it.
I fully agree. I do think, at least through Optimal Dynamics, we're seeing some of the large carriers that implement the technology driving their best weeks and months of revenue per mile, even in this down market, which is impressive. So that speaks to like the potential. But for the long tail small carriers, there are also software companies that we see that are trying to provide the business in a box, we would call it, like the automated back office for power those small trucking companies to do things like automated dispatching and help them with manage their finances. And so I'm hopeful that we'll also see software that helps to take all of the administrative burden off of some of those small companies and help them remain competitive with the larger ones.
I think we've also seen some companies come in and say, we're going to rethink this. And to some extent, we've always just said, we have tons of labor, so labor is never going to be the problem. I used this example not so long ago. Mike, if you and I were in charge of a surgery center, we would say, okay, we're paying all these surgeons $500,000 a year. So we are going to do everything we can to get the maximum throughput for them. How many surgeries a day can I get them? I don't want them doing anything that's inconvenient, not one thing. We don't treat our drivers that way, because they aren't paid $500,000 a year. But the only time that truck is productive is when they're in it. And that truck's expensive. And also, who's going to do that job if we don't start figuring this out? We can't expect drivers to always be sitting around, wasting time, not getting the kind of money they want for being away from their families. So I keep thinking we almost have to get to that place in the supply chain where we say that driver, he's not a surgeon, but the only way that truck is productive, that $300,000 truck or that $200,000 truck is productive, is when he's in it or she's in it.
It's such a good point. And I love the analogy. And that's maybe the last point on Optimal Dynamics. Like, a lot of their customers use them because they want to optimize not just max revenue per mile that I can serve in the next 2-week loop, but I also want to make sure that I get my driver home every 10 days, every 5 days, whatever it might be, because they want to optimize for driver retention as well. So figuring out that balance of how do I hit my service targets, hit my optimal revenue per mile, but also make sure I'm getting the driver home on a consistent basis is also critical for them.
Yep. I love it. I love it. So that's workflow optimization. And again, you guys have an investment there in optimal dynamics. I can say that. And the next thing that we talked about before we hit record was digital connectivity. And it sounds fancy. What is that?
Yeah, this is another area where I think we looked at supply chain when I first came in and thought we've got so many disparate systems of record. We've got, even within one operator, one leg of the supply chain, they might have a TMS, a WMS. They've got a lot happening in their email.
Order systems. Yeah.
Yeah, there's just so many different systems, and many of them been around for a long time, and they don't naturally talk to each other well, and so it takes a lot of custom engineering to connect them. And so I think we've been looking both for better middleware solutions, would be the software term for just infrastructure that can help to connect all these disparate systems to give supply chain operators a single pane of glass. I think that's one of the areas where I'm really optimistic that it'll unlock more applications. Just to give you one analogy from other industries, like we looked at, I have colleagues that focus on fintech or healthcare technology. In both those industries, they made big leaps from kind of pen and paper software processes to bringing everything online. And obviously, they're still making progress connecting all of their legacy systems as well. But in fintech, for instance, there's a business called Plaid, which built integrations to all of the major banks. And they gave you one single point that you could integrate with if you wanted to build an application that could talk to any kind of major bank. And that unlocked an explosion of consumer banking applications, because now it's really easy for me to build an application that helps you manage your finances, because I don't actually have to go to each individual bank and go through all the pain of integrating with it. And so I do think if we see more of this middleware that integrates to all the systems, does all of that painful work, and then gives software developers one single point, one throat to choke to access all of the disparate silos where our data lives, it will unlock even more interesting applications over the long term.
Yeah, I've talked to some of the middleware companies that connect. People listening to my podcast, they may say, oh, we just got some business. I'm going to make up some big companies. I don't know who uses what, but let's say Target or Walmart or General Motors. And you go, oh, that's fantastic. I got that business. But then they want to give you information in an EDI format. And EDI is challenging to connect your company to their company. But now there's companies that say, we'll be that middleware. You can connect to us very quickly, and we're already connected to them. So that connection goes very quickly. And when you think about how that goes into effect, if I'm the sales guy and I say, oh, we're going to save that customer 20% is a little high. We're going to save them 1%, and we're going to see this much revenue. Life is good. And then the tech guys say, yeah, that's cool. About 3 months, maybe 3 months. And then it'll take 30 days to get paid. So 4 months. So it's basically you're talking about next quarter. You're like, whoa, wait, how can I be talking about next quarter in this day and age? Now it could be a week or two. And that should be our expectation. And one of those guys who came on my podcast said it used to be 9 weeks. He goes, now I think we can say 9 days. And he goes, before long, it's going to be 9 minutes, because the AI is going to be able to help us with that probably pretty rudimentary coding that gets us connected.
Absolutely. No, we're equally excited about that, exactly that kind of opportunity. So
it's the time to value for both parties. So if you decide, Mike, you're going to work with me because it's going to save you some money and improve service, you don't want it in 3 months or 4 months. And I certainly don't want my revenue in 3 or 4 months. I want it now. The idea that it takes that long to connect seems so yesterday. And by the way, I've been on projects like that where we thought, I was consulting a very large shipper, and we knew the 3PL that won the business was going to start, and it was going to be like July 1st. And it ended up being like mid-August because of technology connectivity issues.
Yeah, it's a huge pain point, and I think there's more business that doesn't even happen because people know it's going to be such a pain to onboard the supplier or to actually work together. There's business not even getting done. So I agree with you. I think that's still a white space we're looking to invest in.
Yeah, and I think also you said earlier about these silos that we're all in, and I think logistics is its own silo. The whole industry feels like a catch-all to me. So you have warehousing and fulfillment, and those guys are very much experts in their space. Then we have over the road, the guys who own assets. They're very different from the logistics guys who own the freight brokerages, and they're very much tech-centric now and very concerned with customer experience. Great. We have a ton of special services depending on the supply chain vertical. And we have, I've always used like 13 supply chain verticals. Automotive's one, retail's one, food's one. Each one of those has specialty services. And we have to, regardless of what industry we're in, We have to serve them all. And somehow we all have to get connected. And people, one of my pet peeves on my podcast, when people say, we have end-to-end visibility. And I go, from where to where? From the time we pick it up at your factory till the time we take it to the store. I was like, that's 2 days. Supply chain's 16 or 18 weeks. That came from China on a boat. That's a handshake, not a hug. End to end is truly end to end. From the time I gave it from order to cash, from the time I placed that order with my supplier to the time it is sold, that's the visibility I need to make the right decisions.
Yeah. And I think that vision certainly resonates. And I'm sure that the visibility technology will continue to improve and we'll capture more and more of that. I think today, the way that we see folks, filling that gap, honestly, is like our company Raft, which works with freight forwarders. Most of that data today is not digitized yet. It's still coming through in emails. It's coming through in an arrival notice, a PDF or something that gets sent to the freight forwarder. And they're employing huge rooms of people just entering that 2 screens. One screen, they're looking at a PDF, and the other, they have their transportation management. And they're just typing that data in. And that's work that nobody on the freight forwarding side wants to be doing. They want to be spending their time on more strategic tasks. And so companies like Raft and there are others are just helping to use computer vision, take all of that image, all of the information out of that PDF or whatever the image may be, populate it into the system of record so that the user can then go spend their time on more.
And when you can pull that, I'll call it unstructured data, if it's in an email or maybe an attachment, I pull that unstructured and put it into a field. Now, all of a sudden, I can put that with other numbers and start to have some insights and recommendations on improving the business. I've used the term on attachments, which are so prevalent in, especially over the international stuff that Raft's dealing with. There'll be all sorts of stuff in other languages with interpretations, translations right on the same page. And that has to be taken from what I'll call static, unusable, to dynamic. And as soon as I can pull it out of that and put it into a spreadsheet, I'll call it, but it's really a system. Now I can use I can have actual insights. And I've also helped a clerk get rid of their worst job, basically move from clerk to analyst.
That's the perfect description. And that's exactly right. Raft, for instance, leads with that. Let's solve the burning pain point you have that the clerk doesn't want to do this work. So we'll automate the data entry piece. But then immediately after, the next thing they do is let's help with invoice reconciliation. We can look at what you're quoted and what you're actually invoiced and help you reconcile from these really complicated international freight invoices. Or should you pay this invoice or not? So they help with accounts payable automation as the next thing.
It's an enormous amount of freight bills, or especially ocean freight bills, are incorrect and nobody questions it. The guys who audit it, one of my friends does that, he's been on the podcast. He said virtually every bill he looks at has something wrong with it. And it is such a complicated business. I just visited a friend here in the Detroit metro area, and he said, Joe, we do big project cargo, and we're talking about it. And he said, no one questions the price of this. If you can get it close to what you said and it's not a disaster, they just go, oh, good enough. But if you look, those invoices have 13 lines. And I know I certainly can't explain what they are, but I've been part of the team that said, looks good to me.
Yeah.
Yeah, 30,000. That sounds, that's what I was thinking.
I agree. It's I think intentionally complicated, and each modality has its own unique billing aspects, whether it's 3PL or international. Like I said, Raft's really just doing the international. I know you had Matt from Loop on the podcast as well, doing something really compelling and very similar for over the road. So I think
those are incorrect so often also. And the international has, right now, if I was shipping something to you, I was the shipper, you were the receiver. We might have a trucking company in between us, maybe a freight broker and a trucking company. 4 parties, we might all be in the same time zone. If not, we're all in the same country. We all speak the same language. We have the same currency. With freight forwarding, I'm working with a trucking company in Asia, and people who speak a different language, they use different currency. They're on the other side of the world, different time zones. All that information has to be normalized. The way we capture dates here is different than the way they capture dates anywhere else. We're the ones using, today is June 21st. We don't call it 21 June 2024, like they do in Europe and the rest of the world. And so all that information has to be normalized for language, for currency, for time. Even the way we look at the time is different. Somebody has to clean all that up and put it in one format that I want to see it the way I want to see it. The people in Asia want to see it the way they want to see it. Somebody has to do all that. And that's the hard part, is normalizing, first accessing and then normalizing all this data.
100%. I think so much of almost all these issues we're talking about are fundamentally data issues. And so that is the good news is that both the data infrastructure tools we have today are really good at these normalization tests. And also the AI and machine learning tests the tools we have are really good at dealing with messy, unstructured data and trying to bring sense to it.
Yeah. So I think AI is best used right now is to get the data normalized, cleaned up, so we can do some fancy AI stuff later. But right now, if people say, oh, we're using AI, some people are. My friends over at Green Screen are definitely doing that. But the challenge is, I think right now where we're at is in a stage of AI readiness, which is let's get our data cleaned up. So I'm not feeding the machine a whole bunch of nonsense. We used to use the term garbage in, garbage out. I think in this case, it's like garbage in, garbage squared, because I'm potentially making a whole bunch of future decisions on really bad data from the past.
Yeah, couldn't agree more. And so I think that's the good news is that there are more of the data cleaning and cleansing part is being automated now.
The dirty data is being cleaned up by our friends at Raft and other fine companies. So we talked about workflow optimization. We talked about digital connectivity. I know what it is. The next one was automating financial workflows. What do you mean by that?
Yeah, and I think this is actually getting to a little bit of what we were talking about with, for instance, like Loop or some of the accounts payable automation that Raft does, the freight audit and pay workflows. So much of I think about there's the problem of how do we get the goods places more efficiently, which data can help with a lot. And then there's the challenge that all supply chain operators face, which is how do I make sure I'm getting paid the right amount on a timely basis. And so that's another area where it's fundamentally a data problem. We think AI tools can help both to faster reconcile the invoices, make sure that you're agreeing on what is the right amount to pay. I also think there's opportunity to really expedite the actual payments themselves, and particularly for things like international payments that you talked about, where you're dealing with multiple currencies. Today, payments can take a week or more once you've agreed on what the invoice is. And there's real innovation that at least my colleagues on our fintech team are focused on around things like real-time payments, which is faster payment protocols that are being rolled out in many other countries and eventually the US, and just the ability to actually build a more modern international payment system to help expedite these payments across currencies.
Yep. Before we hit record, I was talking to you about our friend Charlie Dehoney, who was on the podcast. He's got a company called Upwell. And Charlie was saying one of the challenges with getting paid, factoring is so common in the transportation and logistics space because you don't think you're going to get paid on time. And one of the reasons you don't get paid on time is because you don't submit the invoice in a way that they want it. And he made the point that we're in the transportation and logistics space, we're great at tracking freight and selling freight services. But when it comes to giving the customer the bill in exactly the right format so they can pay it automatically, as opposed to you going through a manual sort, a manual fix, he said that is a perfect place for AI to check and make sure that everything. So if I'm invoicing you, rather than me submitting it through your portal and then your portal rejecting 30% of them, let AI get in the middle of that and say, Joe, we know exactly how Mike hopes to receive this. We'll fix this, and then you'll get paid on a timely basis. And it is a painful thing because Charlie made the point, the fastest way to grow your business is with your own money that you should have been paid already. And we just take it for granted now that I have to factor it. I have to factor my money. And I think we're starting to see, and I think maybe part of the market will always be using companies. One of my sponsors is Denim. They look at themselves as a financial partner as opposed to what they would say predators. But if you get a demo of their system, you see how much more value they add in the middle than the average factor. I factored money in the past where it was just like, okay, you just get a check in the mail. These guys are giving you really good insights, like who's not paying you on a timely basis, who's your lowest margin deal. Those sound very basic to some people who are in companies that are of a certain size. But if you're a small guy and you go, I don't know, I don't have time to see who's the low margin customer who pays me late all the time. So I do think there's so many opportunities, and I do think we're going to get away from this. Everybody listening who's got a company saying someone owes me money that's past due. That is just the norm maybe it's the norm in all businesses, but it shouldn't be.
Yeah, I think it probably, unfortunately, is the norm in most businesses. I agree. It shouldn't be. And we are seeing examples of innovation across other aspects of the supply chain to help with things like this. We've been looking at some companies that are selling to, let's say, wholesale distributors. We're serving the last mile. So again, very different use case, but most wholesale distributors extend credit terms to their end customers 30, 60, 90 days. And they have a very poor way to underwrite, is this a trustworthy customer? It's mostly based on, they'll try to call around to another distributor. Hey, have you worked with this company? Do they generally pay on time? Maybe they get a Dun & Bradstreet report, which is a snapshot. And so we're seeing companies, for instance, that can, if I was the distributor and you were the end customer and you came and applied for credit with me, there's software now that I could use that say, sure, Joe, you can come apply through this portal. You just have to link your bank account. And I'm going to get basically the ability, this third-party software will just monitor your cash balance and your creditworthiness. And thus it gives you real-time visibility.
Yeah.
Is this a worthy partner to be dealing with? And I think we'll see over time, the world of being able to underwrite customers moves to much richer data, much more real-time data on how you're not risky is, because ultimately for my good customers, I want to give them way more credit terms so that they do more business with me. I want to reward the really good payers, and I want to be, really conscious about monitoring my risk for the riskier customers.
Yeah, absolutely. Absolutely. So I'm going to summarize this, and then I want to get your final thoughts, and then I want to talk about why companies work with your company. And I think also, who is a good customer for you guys? Who's your sweet spot? Because not everybody listening to my podcast, they go, hey, we're a freight broker, or we're a warehouse. That is not even a good fit for us, but it is significant for our industry, because if there was not VC money coming in, we would not have all these cool tools. We mentioned some of the companies that are bringing really interesting solutions. We don't get those solutions. We don't get to be as competitive as we are. So anyway, Mike, we talked about a few things. So we first talked about what is the supply chain roadmap, and that's basically your thesis within BVP. I'll make sure we put a link to that. If you give it to me, we'll put a link in the show notes so people can look at that. We talked about workflow optimization. I think we hear that a lot, but it's still such a big thing because we are still so siloed and disconnected, and we need to be better connected. Next, we talked about digital connectivity, like companies like Raft are bringing. I should also mention that this optimal dynamics that we talked about with the workflow optimization, anything that can make this industry cleaner, but also give you that competitive advantage. It's really hard to have a competitive advantage in transportation and logistics. Every dime counts. We've seen so many trucking companies and freight brokers go away in the last 2 years. And I can't help but think that the companies that were able to invest have a better chance of sticking around. So the first one, workflow optimization. Second thing we talked about is digital connectivity. And then we just talked about automating financial workflows. We know that is such a problem. Everybody, I always say in my podcast, number one question in this business is, where's my stuff? But a close second is, where's my money? So we need some of this financial workflow automation. So final thoughts, Mike, and also, why do companies work with BVP, and who's your sweet spot?
Sure. Final thoughts first. I think just very grateful for you giving me the opportunity to come on.
Thank you.
We talked about it a little earlier, like there's not necessarily as much VC interest in the supply chain and logistics category as there was, but there are absolutely firms, ourselves included, who continue to be really interested in backing early stage companies that are bringing more technology to the sector. In terms of Myself, it's very much still, we are most excited about companies that are touching on all these themes that we just discussed. Anything that's bringing more connectivity between our siloed systems, helping to automate the highly manual workflows that plague a lot of operators, or just better optimize the networks and the flow of goods. And then a little bit about BVP. Our sweet spot is we really want to meet entrepreneurs, founders at their earliest stages. Even if it's slightly too early for us to invest, we love meeting companies when they've just gotten an early version of a product, or they're even experimenting, thinking about it, starting to talk to some customers. I mentioned we recently led the Series A in Good Ship. I met Ryan, I think 2 years prior to us actually investing, when he just had a really lightweight demo of a product, and we kept in touch over 2 years. It was super helpful to see his progress, how fast they executed, and listen to feedback from customers, and thus made it really easy for us to make the decision to ultimately invest when the time was right. We want to make folks super early. And then why did they invest with us, or why do they work with us? Really, I think the things that attract folks to Bessemer are, one, unlike some firms which are more generalist, we really try to be thesis driven. And so when we work with entrepreneurs, they don't have to explain to us the terminology and how supply chain and logistics work. So we understand enough of it that we can go deep with them. And then we've got a really long track record. The firm goes back 40 plus years. And that means that we have both a really valuable network, 300 portfolio companies, and we've seen what that trajectory looks like to go from a seed or a Series A stage company up through an IPO or a big other exit. And so we can help those companies at almost every stage with kind of everything they need, from recruiting, from helping with public relations and marketing, to just providing advice to the founders and the teams that we're working with, and helping them share lessons across the 300 other companies we have that are on the same journey and maybe a stage or two ahead of them. So those are often the things that attract people to come work with us.
Yeah, I think I like what you had to say there, but I think it's a little intimidating sometimes for companies who say, I'm not a finance guy. I've spent my whole career in logistics and I have an idea and we've started to execute on it. But VC, that sounds very fancy and very out of my depth. So I'm assuming you guys are experienced with that. When somebody shows up and says, hey, look, I'm not a finance guy. I've spent my career in the logistics and supply chain space.
Totally. And honestly, one of the kind of core tenets and things we look for in our supply chain investments is that the people do come from the industry. I think it's so critical that at least some portion of the founding team has that DNA and really understands the way that the industry works, because there's so many important nuances. It is really hard for a true outsider to come in and pitch a product to seasoned supply chain operators if they don't fully understand the pain. So yes, we value product, industry depth and expertise over financial acumen any day of the week. And at the earliest stages of these companies, honestly, there's not a lot of finances to be managed, frankly. It's much more about, can we find a product that really resonates with an end customer? And then if you can solve that problem and you can get people to raise their hand and say, I would absolutely pay for this if you build it because this is going to be transformational for me, the other problems are solvable. We can hire people that have the finance background. We can solve all of those other problems. The hardest thing for us to find, and the really rare thing, is an entrepreneur that has an incredible amount of drive, has found a problem that no one else has solved, and they found a clever solution to solve it, and they want to build a really big business. Like, those are the things that we look for. And whether that person comes from logistics or and has any supply chain or has any finance background or not, whatever, they're relevant for us.
Yeah. Now, is there a trend towards founding teams as opposed to, you mentioned an entrepreneur, and I'm assuming you say entrepreneur or a founding team. It just seems like if you have a founding team, there's maybe a little less risk on your end in the case that one guy has a change of heart.
Yeah, I think it's very rare these days that we see a solo founder. Often it's 2 or 3 co-founders together. And to your point, I think it's less risky for everyone. I think it's really helpful to see a combination of skills. You've got somebody that's got more of a technical skill, somebody maybe has more of a go-to-market, and they complement each other. And I think the last thing is, like, being a founder or CEO of one of these companies, it can be lonely, challenging. Like, it's really helpful to have a co-founder because inevitably things are not always going in the right direction. There's a lot of ups and downs, and having a team of co-founders and hopefully investors that you can share those troubles with and can pick you up when things are not going well is really critical.
And I think you do see a lot of times it's the hustler and the hacker, right? So the guy who's the introvert and maybe not, but he knows how to create great software. And then you have the guy who's out selling. And maybe there's a third or fourth party, the one that the ops guy. And I think we've seen a lot in our space where you need somebody who's got the operational expertise, but also I need somebody with the deep technical knowledge if I'm developing a new technology. And I should also say, sometimes people look and go, you either take funding or you don't. What I've always said to people is certain businesses don't need it. So if right now, you and I decided we're going to open a warehousing business, no one wants to put VC money behind that. We also know that we're going to have one location or two locations and then grow using maybe loans or our own profits. But if there's a new space that's popping up and AI looks like one of those, you need to get to a certain market share very quickly, and you need to be able to be one of those leaders so you can be bought or grow. And so I think there's certain technologies that you can't grow at 5% a year and say, I'm going to own that space.
Yeah, I think that's very true. And so you're totally right. Venture capital is definitely not for every business and every use case, but in these opportunities where both the market is moving quickly, you need to invest a decent amount ahead of any revenue. That's, I think, with a lot of businesses, you can market quickly and generate at least a little revenue. Most of our companies, they might need a year of building the software before they can actually sell anything. And so that's also oftentimes a reason to consider it. And then the last thing I'd say is just to be totally candid. Our business is, as we talked about earlier, investing in businesses that can go on to be $1 billion, $10 billion companies. That's how we return our fund. And so I'm always candid with the folks that we work with at the beginning, which is we may not get there. Most of our companies don't have that kind of outcome, but we want to at least believe that the founders are aligned and they want to build that kind of business. Because we never want to end up in a situation where they don't have that kind of aspiration and we're at odds.
They're building a lifestyle business and you're like, oh, surprise. And I got to tell you, I worked at a venture capital backed company out of Silicon Valley years ago, and we were growing really rapidly. So we had 12 million in sales, just 12 of us. It was like a forecasting software. And I remember we celebrated $1 million deal on a Wednesday. On a Thursday, somebody said, oh, there's a board meeting. I go, oh, I didn't know about what board meeting? And somebody says, oh, I don't know. And then on Friday, they announced, hey, we're shutting the business down. I was like, why? And they said, it's a great consulting business. It was a lot harder to get the data from our customers than we thought. And so the business is still ongoing, but it was not. So they said, you guys take it, run with it. That company still exists. I just saw one of the founders not so long ago at a party. But that's not by the way, they were also saying, we don't want to come to your meeting anymore. We have another investment. It's Google. And we're like, oh, all right. That was like 12 years ago. Okay, I get it. We're out. No wonder they don't want to take our phone calls anymore. Anyway, enough of my blather. So what I'll do, Mike, is I'll put a link to your LinkedIn profile, a link to your website, any other links. I'll put a link to that supply chain roadmap if you give it to me, and any case studies you have. I also want to add one other thing. So you have this supply chain roadmap. I would also say you guys have a roadmap for scale for the customer or the people you invest in. So that's another advantage of working with a BVP, is they said, we know how to get there. We have that roadmap too.
Absolutely. And we've probably published more on this content than maybe any other firm. If anyone's interested in learning more about this stuff, we published and put most of that out in the public in terms of these are the benchmarks that we see companies hit when they go from 1 million to 10 million to 50 million of revenue. And these are how you should think about this timing of when to hire these roles and what does good look like at each stage. You're absolutely right. It's an area we spend a lot of time thinking about and hopefully sharing with the entrepreneurial community.
Mike, thank you so much for coming on the podcast. I went way past my time with you. I appreciate you staying.
It was my pleasure. Thanks for having me, Joe.
Yep. And thank all of you for listening to my podcast. Your support is very much appreciated. Until next time, onward and upward. You have been listening to the Logistics of Logistics podcast, where we engage with leaders in the logistics and supply chain community. If you like what you hear, please subscribe, hit the like button, and leave us a nice review on Apple or Spotify or wherever else you listen. Also, please check out our videos on YouTube and connect with us on LinkedIn. We're very big on LinkedIn. And you can also reach us on the logisticsoflogistics.com, our website.